Hello and welcome to another Smaulgld live stream. Today is Friday, July 6, 2018. Tonight's topic is Forget Russia. The big gold flows are in ETFs. We're going to discuss how much gold supposedly moves in and out of these gold ETFs and compare it to some of the other gold flows and the annual gold mining production and so on. But first, let's take a look at the markets today. Even though we had tariffs kicking off on both sides of China and the U.S., the gold and silver prices were essentially flat, with silver closing down just a small bit, 2 cents, and holding on to the $16 an ounce handle, which it also did on Friday last week. So basically, silver has been $16 an ounce week over week. And that ties into one of the things we talked about the other day, that when prices are not moving, there's not much volatility, at least for the retail investor. You don't see a lot of people buying. They're not worried about missing out on a big rally, and they also don't think they're getting a bargain because they haven't seen a big drop in the price. Same thing with gold. Gold also closed above $12.50 this week at $12.54, and it was down $2.80. Over at the crypto markets, cryptos were pretty much, again, flat with the gold price. The Bitcoin price, I guess that's the gold for the cryptocurrencies, or the base, closed at about $6,600. Well, it doesn't actually close. It stays open all the time. Looking at the Coinbase price at $6,600. It's up about 1%. Litecoin down about 0.5%, about $83, and Ethereum about $470. So the cryptos flattening themselves and also on very low volume. Okay. Also on the tariff side, while the tariffs kicked off, and they weren't a lot, I think there were 30-40 billion to start. However, Trump did mention, I think it was $34 billion started on Friday. He warned that subsequent tariffs could amount to about $500 billion. Now, $500 billion would be about, well, it's a $500 billion, but it's about the amount of total exports of China. So basically, he's making it sound as if he's going to put a tariff on all Chinese goods. Now, I would think that would be almost catastrophic, not just for world trade, but more specifically for China. Now, a lot of people think that China's in the driver's seat here, but that would amount to an enormous loss of revenue. And on the flip side, in the U.S., it would amount to a inflation because of the price increases on certain items. However, if it doesn't last long, the impact on U.S. inflation would be fleeting, because not everyone needs a refrigerator at the same time, or a toaster, or some of the other goods that come from China, if indeed they were going to place tariffs on all goods, including finished goods. But the impact on the Chinese would be enormous, because they would have to continue to pay the salaried workers to work in factories where they're obviously not going to be producing as much. So they're actually going to lose money, and the only way they can make that up is by printing up more yuan and issuing more credit, and then also instructing the state-owned banks perhaps not to foreclose on loans or loan more money. So it's only going to exacerbate their credit bubble, because they're not going to have a free market. It's not a free market, but China is not going to allow its factories or its loans to be called in, because they may have a liquidity short issue, because their revenues have dropped unexpectedly because of trade with the U.S. has slowed. So that's something to be on the lookout for. I don't know if that's Trump's master plan to crush China, but they actually, the Western powers built up China, and they seem to be happy to leave it the way it was. The concept behind China was, I remember, was that all the intellectual property and all the innovations happened in the West, and they were saying, we think and they sweat, which is probably not a very attractive way of looking at it, but That was the concept, and that the goods would flow to the United States cheaper, and then the U.S. would send them dollars, and everyone would be happy. Well, it seems Trump is not happy with that arrangement. All right, so let's take a look now at this ETF. The reason I want to mention this is twofold. People get all excited about Russia, and I report on it monthly. And Russia has been increasing its gold reserves, and Russia did have record gold added to its central bank in 2017, and is about on the same pace this year. And that record last year was 224 tons. 224 tons is not that much gold. It's a lot of gold for a central bank, but it's not that much gold at all, given that it's less than 10% of overall mining supply in a given year. And also, since most of that, all of the gold that Russia adds to its reserves comes from its domestic mines. So it makes all the sense in the world that they convert their depreciating ruble into a more stable currency that they have right at hand in the domestic mining supply. So when people get all excited, Russia's buying gold hand over fist, they know it's coming. No, they know how to run their central bank, and they know how to exploit their domestic mines, and they know how to convert their, unfortunately, it's a very weak currency, so it makes sense for them to convert that into gold far more than it does for them to convert it into treasuries, especially since, as we've mentioned in the past, they have little trade with the U.S. and they're under sanctions, so why feed the beast? And if they can build up their gold reserves, it makes sense. But Russia's gold purchases don't add any particular amount of demand that's going to boost the price. Indeed, you may argue that they take some supply off of the table because they eat up 2/3 to 75% of their mining supply, adding it to the reserves, and they sell the rest of it to China, and more recently they're selling some to India, from what I understand. And I've mentioned in the past that India imports 900 tons of gold a year, the country of India, not this Reserve Bank of India. But still, you can see that's 4 times, maybe almost 5 times the amount that Russia is adding. And when India imports that amount, it doesn't seem to change the gold dynamic. All right, so let's look at these ETFs. Now, the issue with the ETFs, it always strikes me when I see the numbers coming out of the ETFs. Today, we saw the World Gold Council mentioned that gold flows in the ETFs were off 49 tons. And that's a lot of gold, 49 tons. That's just 1 month. Now, the overall hold, well, let me just tell you what the ETFs are. They're exchange-traded funds, and they tout them as being an easier way of buying gold. You don't have to buy it. You don't have to store it. You can trade it very easily. And these have become a very popular vehicle for not just trading gold, but some people think they're owning gold as a result. And I want to go through the mechanics of these things because I find it hard to believe when you read how these things work that when you buy your shares in GLD or any of these ETFs, there's tons of them, pun intended, there's many of them, and somehow they're claiming that those shares get created in the baskets and then they have the gold backing them, and they use them when you sell your shares, they remove the gold. I just don't see how they do it so quick, but maybe I could be missing something, but I'll just give you the numbers of what happens in a given month is gold flows in and out of these products. And in June, they fell almost 50 tons. And the number they fell to was 2,434 tons, which means locked inside, supposedly, in these ETFs, not just GLD, but a host of others, is nearly a year's gold mining supply. And people move in and out of them. And the amounts that supposedly move in and out are not just bigger than Russia, as we mentioned, just in a couple of months they can do that type of volume. But compare it to the actual gold, physical gold that people buy. If you look at the U.S. Mint numbers, you're looking at last month, I think they sold 21,500 1-ounce gold coins. They sold you're not even talking, you're talking fractions of tons of gold being sold. Almost none sold 3 months ago. In May, I think they sold 2,500 or 4,000 ounces of gold. So I would say that these gold ETFs are pulling demand from physical gold. And they really have done a sales job on them because they claim that they've given you the convenience of owning gold without actually having to buy it. I mean, it might as well be Bitcoin because you don't, there's the old expression, you don't hold it, you don't own it. But here they're saying you have gold, and they're showing that gold flows in and out of these things in a big way. Now, the interesting thing also about what they reported, if you go to the Gold Council's website, they show you that while 50 tons or so left ETFs, there were some gold ETFs that showed inflows and others that showed outflows. But the biggest one showing outflows was the largest one, GLD. It lost 28 tons. I just wonder where those 28 tons go and how the 50 tons come back in and how they keep track of all that. But then the iShares Gold Trust, which is the second largest, that one lost 17 tons. But then there were a couple of ones I never heard of. Granite Shares Gold Trust that gained 6 tons. That's a U.S. Gold ETF I never heard of. And there's a UBS one. It added 4 tons. And so these ETFs claim to really dominate the actual physical flows of gold, seeing that they have about 2,500 tons of them at any given time, and massive amounts of gold flows in and out of them. And since 2003, they've skyrocketed in holdings that they have, and the flows tend to follow the price of gold. So when the price goes higher, you see more inflows into gold. Now, whether that's correlative or causative, or it's a causation, I don't know. But there seems to be some type of correlation between higher gold prices and inflows into ETFs. And then there is when the price goes down, as it happened in June, you see these outflows. Now, whether they're reacting to the price or whether they're causing the price, some would argue it's not, that everything happens on COMEX. But I think there's some causation as well. The correlation is too tight, and the numbers, if they're selling the gold and the price goes down, that seems to make sense. I cover this from time to time. I put the charts up on a Smaulgld of the ETFs. I also tweet them from time to time because I do update them daily, but I don't keep a library of them. So if you're ever interested in them, just shoot me an email or on Twitter, request the most recent one, and I can post it. Unfortunately, I'm not doing these live streams with visuals. And maybe at some point we will do that as well. All right, so let's just take a look at some of the features of these ETFs. So the 3 issues that I have with ETFs, and this is not investment advice, this is just my observations here. If you're going to invest in ETFs, you want to get yourself a prospectus, read the risk factors, read the whole thing, and decide whether that's right for you. But if the stock market closes or there's a bank holiday, you have no access to trade your shares. Now, if you're buying gold for insurance, my opinion, not my advice, is that doesn't do you a stitch of good. If you think there's going to be some insurance value and you want to cash in your insurance policy and the stock market's closed, or there's a bank holiday and it's going to be closed for a week or 2 weeks, you've just lost the value of your insurance. Now, some people think that you need a collapse in order to cash in. No, you could just have a temporary illiquidity and things could be fine in 2 weeks and the gold price may have skyrocketed, but there's no trading in the ETF, so you wouldn't be able to cash in. Second problem I have is, and some people consider this a feature, is that you have no access whatsoever in most cases to ever take physical delivery of any gold. They make it very difficult to do so. You generally need to have very large amounts, and then there's a lot of paperwork, and it's generally not worth the time, and most people don't do it. There are some that have redemption features that are a little easier to go to, but the reason they don't redeem them, and it's kind of for their own convenience, and also they claim for yours, is that it makes the whole thing easier. The reason you buy ETFs is so that you don't have to hold it yourself, store it yourself, insure it yourself. You just trust everything with them, and you just buy and sell your shares. And again, I don't think they do daily audits of this. They probably do quarterly audits. There's always risk of the rehypothecating, loaning. Who knows if how much gold is in these things at any given point, where it goes, where it stays. You know, the custodians and the JP Morgan. I think that's on the silver side, HSBC, I think on the gold side. But they all have big bullion bank custodians in most of these ETFs. Now, the third one is if the ETF is mismanaged, which it could be. It goes bankrupt, you have a claim on the trust, not a claim on any amount of gold. Now, you compare that to putting your gold in an allocated or vaulted insured gold. The vault could go bankrupt. The company that arranged the vaulting could go bankrupt. But if the paperwork is properly done, the gold that they arranged for you to have vaulted remains in your name and not in the name of the vault or the arranger of the vaulting of your gold. So you're in better shape, and you're insured too. Whereas with the ETF, you have a claim on the trust and no claim for any amount of gold. So to my mind, these ETFs are actually good for the people who are always claiming gold set to skyrocket, game over, game changer. Why? Because those people are not holding gold for insurance. They're holding it for a speculative win. Well, if that's what you're holding it for, then you don't need to have it. You don't need to barter with it. You just want to make the fiat profits. And in most cases, if the market stays open and they skyrocket, well, then you can trade in and out of them, and it's very simple. It's actually a very convenient way to get exposure to the price of gold. You don't have to lug your monster boxes down to the coin store and exchange them. You just push a button and you trade it like a share. That's why they're popular, because people do trade gold. Most of people who trade gold never want to see it. They want the fiat profit. But if you do want to see your gold, or you are worried about not having access to the gold or the price of gold in the event of a crisis where the banks close, then the ETF is not for you. All right. I think that's about all I have on ETFs. We'll take a look at some of the comments. But again, if you want to see those charts, I do track the charts on a daily basis, but I don't post them every day, obviously. But I guess another analysis, not analysis, but analogy that I've come up with is that let's say you're buying water futures because you want price exposure on water. That works until you need delivery of the water in case of a drought, and then all you have is a claim on water worth an amount specified in fiat currency, but no actual water to drink or use. So that's the difference. You're not getting the physical commodity when you might actually need it. You have exposure to the price, which in most cases is fine, and you can cash in and out of these things pretty easily. Again, not investment advice. I'm just telling you what I know about ETFs and what I know about vaulted and insured gold. And that's what gold, I'm not selling gold money either, but that's what gold money is. It's insured, vaulted gold. Bullion Vault has that. Goldcore can arrange that for you. There's a number of them that will arrange. But the thing there is you pay a storage fee, much higher than you would the management fee of the gold ETF. But in most cases, those companies will give you a physical delivery option, but also that physical delivery option will also be expensive. So the price of your storage at gold money, and your delivery will be more expensive than just buying and trading the ETF share. So there's the cost there, but you have more security that maybe that if there is an issue, that gold still is yours, and it can be delivered to you, even if it's at a cost and at a fee that you may not like, but at least that is available to you. All right, let's take a look at the questions. I haven't been looking at the okay. Zilla, Smaulgld, the last place of refuge from the mainstream media and the clickbait alternative media and hucksters. That's right, we have a small group here that understands that. Chicago Electric Bicycle, good. Tariffs work. I'm trying to remember what I was talking about. Tariffs do work, not as tariffs for tariffs' sake for protectionism, but tariffs used as a strategic weapon can clearly work. If you can use them as a bargaining chip, you can use them as a marker, as a warning, you can change the landscape of trade. And I think that's what Trump is trying to do. And by mentioning he might throw the whole kitchen sink at it, he's basically said, I don't have a problem with the nuclear option. And that has to frighten the Chinese because their whole economy has been planned on selling $500 billion worth of stuff to the U.S. And if all of a sudden they don't have that coming in, then what do tens or hundreds of millions of Chinese workers do? Do they sit around and do nothing? Do they still get paid? What happens to the revenue that's supposed to go to the bank loan? Doesn't come in. So you see, the U.S. would put up with some inflation, and that would also cause, it wouldn't cause a complete reindustrialization. Yes, that's not going to happen, but it might cause certain industries who are either haven't left or industries where you can convert some of your capacity to things like toasters and air conditioners and other white goods like refrigerators, TVs. They could start making them again, and that could be a permanent feature, even though it was a temporary trade war. So we'll see. Database DNA, anything to the high volume in the COMEX digital silver exchange. I look at that stuff all the time, and people make claims on it. Never happened before, guaranteed to this. I place nothing on the commitment of traders. I look at it and it doesn't mean anything to me as for predictive value. In fact, anytime somebody predicts skyrocketing gold or silver based on something they see on COT, my experience is it's the other way around. All right, what's the next question here? Whoops. All the president wants to do is level the trade playing field. That's right. That's what I agree with. Maybe Trump will get China to drop their tariffs and open their markets to U.S. goods. I don't see why that's not relatively self-evident, but people think that he's messing up on this. China's stock market is down 15% in the last month and a half. Actually, it was down 25% in the last month and a half, and it closed higher today, but overall it's down about 25, 27%. Database DNA, high tariffs equals higher prices for consumers. Absolutely. Who benefits? Not consumers. Absolutely not. But governments appreciate the higher sales tax revenue on the higher prices. They also, the tariffs when they come in, if you recall U.S. history before 1913 when they passed the federal income tax, the U.S. federal government was funded on tariffs, if you can believe that. There's no income tax. Poppy stuff. Talk to our kitchen cabinet vendor. We are feeling the pinch on plywood. I'm not going to blame China for that because if you go back and look at your lumber costs, prior to any of this talk, they had tripled in the last couple of years. So that's not a Chinese issue. It's not a Canadian issue. It may get exasperated by it, but if you look at your lumber charts, pull up a Bloomberg lumber chart, they have been, quote, skyrocketing of late and not because of tariffs. But plywood coming from China will get more expensive if it's already expensive. So I don't think you're seeing the pinch on plywood from tariffs yet. You're just seeing the pinch from rising wood costs, lumber costs. Database, DNA, everything used to be made in Japan. That's right. Japan was going to take over the world. Then it was made in China. Who will be our next slave labor? A unified Korea? Possibly. I also think one of the things that China wants to do is move into Africa and Southeast Asia and create, because they want to become like the United States. You know, if you think of the path of the United States, U.S. became an industrial powerhouse in the 40s and 50s. And then in the 60s, it kind of said, screw this. We just want to spend money, go to the moon, and create a welfare state. So let's move into more of a service industry. And eventually what happened in the United States was they offshored the manufacturing to China. Well, China doesn't want to live like that for too long. They're probably going to want to offshore their production and live like people in the United States and then get people to take the yuan, and so it goes. All right. Hubzilla. I would like to know if indeed trade deals in the past were bad and whether Trump is right in trying to achieve fair trade. Even if tariffs are bad, all things being equal. We only have to look at that they weren't bad if you agreed with the premise of why the United States was entering into them. If you believe that Americans aren't made to manufacture, they're made to do services and think about stuff and innovate and create design and flip burgers, then the concept was sound. And if you believe that U.S. companies, what's good for U.S. companies is good for the U.S., and if the U.S. companies can make more profits by lowering their labor costs, then the concept was sound. The concept wasn't sound if you believe the opposite, that you want American work to be done here. You don't want to be reliant on foreigners for the production of essential goods. You don't want the service jobs as much as you want the manufacturing jobs because the service jobs are lower paying. See, what they figured was a win-win was the manufacturing jobs in China were still less than the service jobs, paid less than the service jobs in the U.S. Because manufacturing jobs got so expensive, especially because the unions in the Detroit, in the car making, they were getting paid $100, $120 an hour. Whereas in China, in the beginning when they started this stuff, they were basically paying them the price of a bowl of rice, or, they were not paying them very much. And I'm sure wages have increased in China, but when they first started over in China, the enticement to get them into the factories, they didn't have to pay much at all, because remember, a lot of the people in China before they started to industrialize were subsistence farmers. They weren't doing very well. So if you could put them into these nice apartments and feed them, that was and have a little spending money, that was a huge deal and a big enticement to move people from the country into the city. If Trump can get China to drop all their tariffs and trade barriers, that would be huge for U.S. companies. That would be huge for the world. If actually China, the U.S., EU actually had free trade with very limited tariffs and equal trade, where basically if there were tariffs, the only way one would win is if they were importing more, and then they can actually collect more tariffs. But it would increase the amount of trade if you took away most of the tariffs. Trump is a businessman and will start high and will negotiate. He may not get everything he wants. Will end up better than he started. I think what happens is people underestimate, like they did Reagan. They just think Trump is a dolt. And he doesn't know what he's doing, and he's just rude and crude. He can't read. He doesn't. But he does understand the negotiating tactic, and he does know how to troll people into putting themselves in a weaker position. He may do it in a way that may appear because whatever his tactics are, I actually believe they are effective and they are intentional. I don't think he's just popping off and says stupid. You don't get to be president by just saying whatever pops into your head and just acting irrationally and erratically. Now, people want to believe that, but if you think of how organized the media is and supposedly the Democratic Party was, and they couldn't beat him, the same with all the other Republicans, there's something to it. And to underestimate his ability to get things done is a big mistake. When he got the tax cuts through, I'm not praising him. What I'm doing is saying, do not underestimate his ability to get things done. He got the travel ban in, even though the courts lined up against him. He got Gorsuch in. He won a 5-4 decision. He's going to get another judge in. He seems to be, and he evaded this whole Russian collusion thing with Mueller. They thought that was going to sink him. So he does tend to have 9 lives, and you just watch what he's doing. Forget his politics. Forget whether you like or dislike him. I think that's where people get blinded. They either hate him so much or they just love him so much, and they don't really see what's going on with him. And I think that puts them at a disadvantage in being able to understand how he's operating. 8 still, is there a threshold of higher volumes of ETFs which might alarm the central banks to the point they try to suppress this information like they did with Fred? I don't know what that Fred thing was about. I don't think, again, no, I don't think anyone cares about gold to the point where it's an issue where they're going, like someone said the other night, is it possible maybe that they're telling us that they're not selling any gold or silver, but they really are? No. I mean, the reason I say no is because I know that they're not selling. Just talk to bullion dealers, look through what gets sold on my site. It's just anecdotally and real empirical evidence is they're not selling anything. The gold inflows are what they are. Now, they may not be what they are. Well, hold on. What I'm saying is that they're happy that if people are going to buy gold, buy an ETF, because you can, if you wanted to, you can hide the fact that there's not all the gold there. There's some of it there. It's all there, but it can be lent out and you wouldn't know about it. As long as people, one of the things that's clear is in a fiat system, you want to make sure there's a disincentive for people to hoard physical commodities like gold and silver and anything else, and to be satisfied through some type of representation of that. So an ETF is perfect. A COMEX contract is perfect. They prefer that you hold fiat and notes and stocks, but if you have to buy gold, they clearly prefer that you buy it in the form of an ETF than you actually ask somebody to give it to you. Unscammable. I don't like physical gold and silver because you have to pay transactions fees to sell the product and transactions fees to buy it as well. Then you have to store it and you have to find out where you're going to store it. You're going to have to insure it, or you're going to have to just take your chances without insuring it. So it is, that's right, plus it can get stolen. And if you want to store it safely, you have to pay also. That's right. So the point of physical ownership is only valid if you, how do we put this? If you've decided that that is the safest thing you can do because we're going to have a stock market collapse, we're going to have a bank holiday, we're going to have the need to have all of our wealth in a hole in the ground. Now, I don't know if that's prudent thinking. Some people have been browbeaten into thinking that's where everything is headed, Mad Max world, and as long as you have your hole in the ground with your metals, you're protected. And you can think of scenarios where maybe that's not a good idea. I'm not giving advice. I'm just saying that preparing your whole life based on a collapse scenario, you do what you want. All right. Database DMA, just like the IMF, the charter for the ETF says it does not have to deliver physical, right? Just another, yeah. And I think that's exactly what's happening in database DNA, is that it's a way of, I'm sure there's gold in the ETFs, but I'm sure it's not to the ounce, and I'm sure that there's probably some lending going on and you don't know about it, and you don't care, and you can just trade it whenever you want. As long as you could trade your shares at the then going price, most people aren't even paying attention. 2008, gold spot collapsed, but gold bullion went up. That's right. And the same thing happened with silver eagles. That was a short-term phenomenon. But that's a case where, see, this is what I was talking about. If the ETFs are closed because the market is closed, and you have a silver eagle, and back then, if the ETF was closed and silver was, $8, $10 an ounce, you could have sold that silver eagle for $20. So there are periods of time where clearly having the physical, you can cash in, and that's where the ETF is a problem, because you couldn't cash in at the time. The price had gone down, and then even when you could cash in, the price was down, even though the spot price of the physical was higher. But those periods of time, they don't last very long. because eventually the paper market just catches up to where the physical market is and then knocks the physical market back down. Plus you can do limit orders on ETFs. That's right. See, if you want exposure to the price of gold or silver and all you want to do is get rich or short it or make money, there's no point in holding the physical. The reason you have the physical is because you want it for your insurance policy, you want it for your Mad Max or whatever reason. But if you think you're just going to get rich because gold or silver go higher, you don't need to have it. You can just trade these things. And even if you don't trust them, it still doesn't matter because they're still pegged to the price of the commodity. That's why they're popular. Because people, if they don't have it in their head that they have to have a coin in their hand, they will buy and trade these right next to their Apple shares. All they have to do is log into the Schwab account, type in GLD, and hit how many shares they want, and they can chart it, and they can figure out what the price is, when they want to buy it, when they want to sell it. They can put limit orders, put orders. You can't do that with physical. You have to run back and forth to the coin store, and every time the price changes, hopefully get there in time to sell your gold or silver if that's what you want to do. You want to play the price. So they are attractive in the sense that they're trading vehicles. No two ways about it on Smaulgld. China is terrified of trade war. They have a lot to lose. Absolutely. They're the ones selling stuff. The people that, mostly the gold bugs, they keep talking about how China will just buy that stuff themselves. No, they won't. They can't. It's an imbalance in the economy. They can't just turn around and say, oh, well, the United States doesn't want $500 billion worth of stuff that we ship them. We'll just like gorge it on ourselves. It doesn't work that way. Good try, Satan. Ha. Okay, Pad. You're right and your safe is irrelevant to what the market does. Pad. You're right and your safe is irrelevant to what the market does. Don't understand that one. Joshua. Once currency bedrock, gold's function as safe haven too has been stripped away by the entirety by the dead hologram. Unfortunately, that's true. That is definitely true. Is the debt hologram, as Joshua calls it, people have accepted that paper and digital are all more valuable. And the reason for that is they point to convenience. You can buy it, you can trade it, you don't have to do anything with it. They've made physical assets a flaw instead of a feature, and the reverse for digital. Worse yet, the culture has been brainwashed not even think of gold as money anymore, let alone source code. Correct. Gusta broken. Smart products are for dumb people. All right. Well, thank you very much, everyone, for joining me this evening. Be sure to join us every night at... oh, wait a minute. I missed a few comments here. I missed a lot here. I'm sorry. Whoa, I got to go back here. Oh, there's a lot here. I don't know how I missed all these comments. Let me get back to them here. Okay. Sorry about that. Let's continue. Whoa. How did I miss? There's so many comments here. You guys are on fire here. All right. So the last, let's see, 2008 gold spot collapse with gold bullion. We covered that. Plus you can have limit orders. We covered that. China's terrified of trade war. We cover that. China, Russia, Europe buy physical gold, says S. Yep. Although not so much in Europe. I would say that the Russian numbers, the physical gold, there's physical gold buying in China. Also India. Not so much in Europe. I buy Gold Corp stocks, says Chicago Electric Bicycle. They just announced a partnership with Carlos Slim in Mexico to develop more mines. China did very well today. Good evening, everyone. Tom Manley. See, I missed this one. FDI insurance is not worth a damn. It clearly isn't. S stocks equal Ponzi scams equals ETFs. That's what an ETF is. It's basically a stock. And that's what people like about it, but it is not gold. You don't own gold, but they've convinced people that that's a convenient trading. How is FDIC not valid? Don't have the time to go into that, but maybe we'll do a whole show on Federal Deposit Insurance Corporation. Database DNA, gold versus ETF. Well, I don't want to get into that. Yeah, it's way underfunded. S, US equals 210 10 trillion of unfunded liabilities. Correct. Total public debt, 19 trillion. It's actually 21. Yeah, okay, 21. Yep. U.S. equals debt kind of life. Unfortunately, though, that's true with all the Western world and China and Japan. There is not a society other than, I would say, Russia, in a developed world that isn't 100% saturated in debt. All those U.S. numbers are true. Everybody points to them. But the European numbers are horrendous. The Japanese numbers are horrendous. And the Chinese numbers are horrendous. Now, they all have different economies, but they all have unfunded liabilities, aging populations, and they are addicted in one way or another to debt. It's not just the United States. Chicago, millions of unemployed factory workers in China will ride over. That's right. That's exactly my point. When the reset to gold happens, you also pay a heavy price when they audit their gold. I think that's just, I don't know where this, people insist there's a reset and somehow it involves gold. There's nothing in these people's DNA or backgrounds or educations or anything they've ever learned that would ever make them think that gold is what they want to do. They are based, all the central bankers, the IMF, it's all about debt and debt creation and credit creation. It's not about gold. It's not about who has how much gold. That's the only thing that the people in the gold community think about. The rest of the world, the financial people, they don't think about gold. They downplay gold. They don't even. So I think people are holding off on, well, they're going to reset and then gold is going to get revalued. I think there's a very slim to none chance on that. Yes, China's number one fear is civil unrest. Well, I don't know what they're going to do, but China electric bicycle. Dollar gets stronger in a trade war, which means American companies have easier time buying products overseas will not pass on the price increase to the consumer. Well, if that's true, then the U.S. clearly has the upper hand in that one. And the number they tout is 66 million. Coincidence? I don't think so. 66 million. Are we talking about the China? I don't know what that is. 1929 equals 9,000 U.S. banks failed, plus U.S. trade tariffs extended the depression by 5 years. Correct. Now the question, is whether the trade tariffs are the same in this circumstance. The trade tariffs had the effect in the 20s and 30s of Smoot-Hartley, whatever it's called, of basically cutting off trade. Obviously, if that happens, then you will have a depression. But the question is whether this trade war will lead to just a cessation of trade amongst countries, or will it create just a rebalancing of tariffs? Unscammable. I just noticed Business Insider and Zero Hedge ran reports saying the FTC is underfunded. Always has been. And I've studied the validity of Zero Hedge and Business Insider, and they are the worst speculators. That doesn't mean they're wrong, though. I mean, they can make up stuff from time to time and be wrong. But the FDIC, I think if you did a quick search and pull together some research, you'll find it is underfunded. It's just not even a good idea, but not going to get into it at the moment. Gold is actually beautiful to look at. Women like gold, not Bitcoin. Obviously. Don't hold your breath on that one. The current amount of China's tariffs that Trump will propose will affect 0.003% of China's GDP. At the current amounts, yes. But if they increase them to 500 billion and they last a long time, then that number starts to get significant. Yeah, right now, that's the thing. Right now, what they have out there is not a big deal. Yield curve inverting leads to massive stock market crash soon. The yield curve, for those who don't know that, I wish S could just type it out for us, but that's when you get the short term, the gap between the short term and the long term bond shrinks, and then at some point the short term becomes a higher rate than the long term, and that has always been a harbinger, as S is pointing out, to a recession. Tom likes the yellow metal, even though he's not a woman, he says. I suspect mining stocks crashed too. Everything crashed. Even the price of gold and silver, as you mentioned, they went down in the paper market during the 2008. Right, FDIC, we'll see that for another night. In Chicago, there's tons of empty factories used to employ thousands of people. It's very sad to look at when they take the train. This is the result of free trade. Well, you know, those factories could get filled up. People underestimate how quickly a country can industrialize. They say, oh, once it's gone forever. Even in the 30s, Hitler's Germany industrialized very fast out of the ruins of their hyperinflation. The United States got bombed in 1941, and by 1944 it was a mega powerhouse, and that was in the 30s and 40s, nearly 100 years ago. These factories can be designed, built in 6 to 8 months nowadays in some instances. So, all right, let's see. There's some great comments here. I'm sorry I missed them. The yield curve invert doesn't mean imminent recession. Well, it doesn't. I actually was thinking about this today. Historically, though, there is, again, maybe it's not a causation, but there is a correlation. And it has historically indicated that. But again, that could be a coincidence, but it's not a rumor. It's actually shown that somehow is a problem. All these things that, as I was mentioning with the flows in and out of ETFs, may just be a correlation, not a causation. As in the past, as it says, it is a leading indicator. One day you'll wake up, the Dow will be 2750. All right, I don't know what that was. All right. Pat, government speaking, control asset is propaganda. Correct. That is why zero government published statistics have no basis in reality. Well, they have some basis in reality, but they have no practical base, you can't practically rely on them because they're all designed to present an overall picture, and that's what Joshua calls the hologram. The Dow went down 2750 points in one day. We'll only go back to it was in September 2017. Yeah, all right. It's on its way back down. Have you noticed Bank of America's published report shouting a 40% downturn in the market? No, I didn't see that, a downturn in the markets, but I wouldn't doubt it. Database DNA, how's that special prosecutor promise Trump made in the debate going? I think most people would prefer getting the big things done first. And he actually is. I mean, I don't think he's focused on going after Hillary Clinton. All right, let's see what we got here. Now Ponzi scammers are pumping this AI crap. Pat, if the market starts to head south, you may not have anyone on the other side of the trade until you get a margin call. That is correct. But the gold in your safe doesn't care about what happens outside. That is also correct. That's the key of the physical ownership. That's on the plus side. The Ponzi scammers are selling physical gold in volatility. I think now we're caught up here. Yep, we're caught up. Okay, well, thank you. Well, why would anybody that watches YouTube economics want me to be right? Unscammable, you know, you're outspoken tonight. I thought we were going to get you on the show. I think we had an issue with the Skype, but if you can get that working, anyone on this thread right now wants to come on the show, let me know. And we'll do a half-hour, 45-minute interview, and you can state your points of views, and I'll question you, but basically you have the floor for that period of time. That's the Smaulgld Subscriber Sound Off series. You can check it out in the playlist. I've done dozens of them. And basically it's mostly people that are just following the show. You don't have to have a website. You don't have to have big internet presence. You just have to have your thoughts collected. And I think every one of the interviews I've done have been well received. Not everyone agrees with what everyone says, but at least you get your point across. If you're interested in that, let me know, smaulgld@gmail.com. And thanks again, everyone, for joining me tonight. Sorry I missed all those comments. I'm glad I got back to them. They're all good. And we will talk to you tomorrow night. Oh, by the way, did I tell you about the, I think I did, yes, the Silver Doctors Smaulgld interview is up now. So go on over there and check that out. Or you can go to the smaulgld.com and you can find the embedded YouTube there as well. Thank you very much. Good night.